violated.
Good morning, everybody, and thank you for joining us for this rather exceptional press conference for an exceptional economic outlook from the OECD. This morning there'll be a presentation by the Secretary General Angel Gurria, followed by a presentation by the Chief Economist Laurence Boone. All the material is available online, and there will be simultaneous translation in English and French. For the journalists watching on the Zoom application, we'll be able to take some questions if you use the question and answer button. Please identify yourself and your media. We'll try and get to those questions after the presentations. With that, I'll hand the floor over to the Secretary General of the OECD, Angel Gurria.
Ambassadors, ladies and gentlemen, dear friends, we would usually release the economic outlook in the context of our Ministerial Council meeting with ministers coming to Paris. Of course, that had to be postponed this year, but under the leadership of Spain, who is the chair of this year's ministerial meeting, we will be holding at noon today, in a couple of hours, a virtual roundtable with ministers discussing the economic situation and the policy priorities for the recovery, precisely the contents of the economic outlook this year. Now, we're in the midst of a combined global, very global, perhaps the most global health, economic, and social crisis. And it's simply the most severe any of us have ever witnessed. 400,000 deaths already, 7 million recorded cases so far, both numbers likely being significantly underestimated. Now, on the economic front, the 6% decline in global GDP that we foresee in 2020 is larger by far than any we have projected in the 60 years since the OECD was created. Now, hundreds of millions have become unemployed. And now that is in the scenario where no second wave of infections happens. In the event that it would, this kind of double hit, the fall in global GDP would be over 7.5%. And we'd be looking at perhaps 40 million more unemployed. Critical sectors for our economies and societies have been hard hit. Tourism, air travel, SMEs, to name but a few. In addition, global trade volumes, which were already stagnating, before the crisis, we didn't have a wonderful time. We were in a slowdown. We were already, in some cases, negative growth in some countries, etc. And then the COVID hit. So trade was already stagnating before the outbreak. And we expect it now to contract anywhere between 9, 11, perhaps 12%. For the year of 2020. Now, throughout this crisis, I've stressed that presenting the problem as a choice between lives and livelihoods, meaning a choice between health and the economy, is a false dilemma. If the pandemic is not brought under control, there will be no robust economic recovery. Our governments deserve credit for these decisive actions that they have taken to contain the outbreak. In a few commendable cases, that meant testing, tracking, tracing from the very outset. But most countries, however, were compelled to resort to lockdowns of varying degrees. This meant that health workers were left to handle the waves of infected people. And I have to say here, we owe them a huge debt of gratitude for their tireless and selfless efforts. And we'd like to render homage to them. As a result of these strong containment efforts, the infection rate has fallen sharply in most OECD countries and in many others that followed these trends. In fact, containment measures are now being eased. Now, the need for skillful policy action is now equally important as it was during the first phase of the crisis. Policymakers moved decisively to cushion the blow to the economy while it was placed in what we could call an induced coma. But they now face the daunting challenge of quickly and completely reviving the patient. The policies put in place now will shape our economies for decades. I would like to emphasize 3 points that seem relevant. First, policies need to mitigate the inequalities that are being worsened by the crisis. We know that many of the worst off and the most vulnerable people are being hit hardest by the pandemic. The young, women, those in precarious or informal jobs, those without savings, those with limited digital connectivity, some 1.2 billion children worldwide who are still affected by school closures. And many of them, by the way, have no access to online learning. Now, one particular imperative for limiting the worsening of inequalities is to prevent unemployment from getting stuck at very high levels. That would set back a whole generation of young people and undermine their long-term potential. The second thought that comes to mind is that it is essential that governments foster more resilient, inclusive, and sustainable growth. The aim should not be to go back to quote unquote normal. Actually, normal was what got us where we are now. So to take just one example, air pollution was killing more than 4 million people a year worldwide before we discovered that it also aggravates the consequences of COVID-19. Reductions in air pollution will make vulnerable segments of the urban populations more resilient to health risks. And of course, the climate emergency has not gone away. It continues to be our most important intergenerational responsibility. Responding to this crisis and tackling climate change does not have to be a choice. It does not have to be either or. There are things governments can do to address both challenges at once. For example, they can make sector-specific financial support measures conditional on environmental improvements. And in supporting investment for the recovery, they can direct public investment and also incentivize, encourage private investment to accelerate the transition to a low-carbon economy. Now, while the current crisis has highlighted the need for more resilience, the outlook reminds us that simplistic reactions like imposing trade restrictions to quote-unquote shorten the global value chains or lessen reliance on particular foreign suppliers would have serious negative side effects. Given the ratcheting up of bilateral trade tensions in recent years and the undermining of global rules for dispute settlement, care must be taken to enhance resilience without sacrificing the benefits of open markets. My third and last thought is that no country can address a pandemic crisis alone. All countries need to implement testing tracing, tracking to keep the virus contained. Many will need help. In addition, countries should cooperate to develop, manufacture, and distribute a vaccine or the treatments to all who need them. And that's the whole of the world. As long as the virus is widespread somewhere, the threat will remain everywhere. And economic costs will persist as some borders remain closed. Now, in the wake of the Great Depression and World War II, our forebears recognized that interdependence and built an international architecture that actually delivered. It delivered the most spectacular, sustained period of global economic growth ever. I have said that what we need now is the same breadth of vision together with the same ambition, if you put together the Marshall Plan and the New Deal, except in this case at a global scale, a global ambition and a global vision. Now, there are a few glimpses of such vision. We all recently had the Franco-German agreement on the EU Recovery Fund, the recent successful Global Vaccine Summit, and those will help to roll out the future COVID-19 vaccine on a global scale. That is the idea. But of course, much more is needed given the size of the crisis. The OECD is working hard to support the necessary policy response. In addition to our regular reports, like today's Economic Outlook. In March, we created a digital hub on tackling the coronavirus to draw together policy advice reflecting the organization's wide-ranging expertise. One single way in and one single way out too. All the talent, all the expertise, all the skills in the OECD together applied to fighting the virus. There are now around 100 policy briefs that have been produced by the officials and experts of the OECD. We've had over 300,000 visits for these policy briefs. We're also working in very practical ways to deliver multilateral solutions. For example, in the wake of the current crisis, governments everywhere will be left with heavier debt burdens and the need to mobilize tax revenue in a fair and efficient manner. One part of that effort will be ensuring that multinational enterprises pay their fair share of taxes. And a key aim of our work for the G20 focuses on meeting the tax challenges arising from the digital economy. We're working hard to have a solution by the end of this year. We're also committed to providing the data, the analysis, and the policy advice to get the world through this crisis and onto a better path. A path with, in the words of our own motto, the OECD's motto, better policies for better lives. Now, I would like to give the floor to our chief economist, Laurence Moon, who will take you through the findings of the report.
Thank you. Thank you, Secretary General. And I would like to say good morning and welcome all of you online. I hope you're in good health. And I also hope you're taking good care of yourself. This report will be very sobering, and all the more that I think this is not working. So if somebody can help me with the slides, okay. And if we can move to the next one to start with. This is probably the most uncertain and dramatic outlook since the creation of the OECD. We're facing huge uncertainty. We don't know much about the virus. We know it's in many parts of the world. We know it's receding in some. It keeps on expanding in others. We have never been confronted by such uncertainties. So we cannot make projections as we normally do. So what we've done this time is we have selected the two most likely scenarios in our view. One, which is the situation we are in, and the virus is contained, it does not come back. But there's also one where it comes back. In both scenarios, the shock to the global economy and living standard is absolutely unprecedented, and it will have long-lasting effects. Can we move? Slide. Our outlook is based on the world going through these stages. So there are three phases in this pandemic, and not all countries are in the same stage. Phase one is containment. Phase two, in orange, is when the virus looks more under control. Economies can reopen progressively, but physical distancing is still affecting business, and people and the economy is only partially working. The green arrow at the bottom is if the virus remains contained, then we are continuing progression in the right direction. But the red arrow at the top, it's a new outbreak. We have to go backward. We have to contain again. When we will, sorry, can we go back? I just want to say something before moving on. Phase three can only happen like life as before if we have a vaccine or a treatment or the virus is eradicated. But for now, we're not there. So let me first show you what this uncertainty actually means. But just look at this drop. The shock caused by the pandemic and containment measures is just colossal. We've never recorded such a dramatic drop in global GDP. In the first quarter of this year, where containment was very measured and mostly limited to China, GDP contracted by 3%. Now in the second quarter, where most OECD countries have some form of confinement for 6 weeks or 2 months, then we estimate the world GDP collapsed by 10%. You can imagine where does that lead us? The starting point is tremendously low, and the recovery will struggle to move us back towards where we were in 2019. This chart shows the level of GDP, so the economic activity for our two scenarios. The single virus outbreak, which is the blue line, and the one where the virus comes back, which is the red line. And the green one is the path we projected in November before the crisis. So what does that mean? First, global GDP is still below what it was in 2019 by the end of 2021. And if there's another outbreak, it will be even further down. That's the red line. Second thing, in both cases, you see the beginning of the upturn is a sharp V. But that's because some sectors can reopen nearly normally. That's food retail, manufacturing, construction. So we get a sharp rebound from a low starting point. But then other sectors cannot fully go back to normal. So after the initial rebound, climbing back is more difficult, and the economy stays below its potential. Now, the main difference between the two scenarios is that the slowdown lasts longer, not only 2020, but well into 2021 if we have another wave of the virus. Now, let me show you what that means for countries. And as you can see, it's very, very dramatic. All OECD countries are in recession, and a large number of them are in double-digit recession. You can spot some group of countries, but really what is really striking is everyone is going down and being hit hard. And the renewed wave, which is the red block on the projection, worsens not only the 2020 economic outlook, but it also affects markedly the 2021. And you have all the numbers in the annex. And this is why the economic damage will be long-lasting. The massive uncertainty regarding the virus, but also consumer behavior, trade relationships, all that will hold back investment. What are the other severe implications? Well, first, what you can see here is that the crisis is really, really tough on people. Unemployment will jump, and quite dramatically, for all countries, and much above what we saw during the global financial crisis in 2009. However, when we take into account the depth of the recession, the increase in unemployment, as dramatic as it is less severe than what we would have had in the absence of massive government intervention to keep people in jobs, to preserve their income. Having said that, one of the big concerns we have when we look at these slides and when we think about people is informal workers, because they're very difficult to reach by any support. Now, another very dramatic effect that you can see on the screen is public debt. Governments have gone out of their way, and rightly so, to support people and firms during the crisis. But quite obviously, soaring fiscal deficits and a very sharp drop in GDP are pushing the public debt to GDP ratio very, very high. The debt increase is for all economies and much larger than what was observed during the global financial crisis. In addition, debt is bound to rise even further because we have to design recovery plans. Governments will need to continue to support people and firms until the recovery is well established. So now I would like to stop a second and make 2 points about this debt rise. Given the exceptional nature of this crisis, of the transition phase we're in, fiscal support is needed to ensure growth recovers fast. And higher growth will make it easier to pay back the debt. But, and that's the second point, because there is no free money, spending should be well targeted for health, for the most needy people, and for the highest quality investment. So now, as you can see, the picture is pretty bleak, but the outlook is rife with risks. So let me highlight the 3 key ones. Vulnerable and young people are most at risk from this dramatic situation. And what you can see on the left-hand side chart is that unemployment collapsed most for low-paid, low-qualified workers. And what you can see on the right-hand side is that young people are also going to be disproportionately affected. And that's because many of them work in the hardest hit sectors. That's tourism, hospitality, entertainment. And those sectors, they're also the one where the non-standard form of contract are the highest. That's the fixed term contract, the self-employed, the temp jobs. In fact, that's all the people that usually have the most difficulty accessing good quality jobs. These groups will be hit very hard, and that could fuel social tensions. I don't think we can let young people be scared for life by the crisis. The second big risk is the high level of firms' debt. We've warned about it in many previous outlooks. We entered the crisis with a very high level of non-financial corporate debt, and you can see that on the left-hand side. But what the right-hand side chart shows, and that's a real concern for us, is that the firms which are the most leveraged are in the hardest hit sector. It's accommodation and food services in green, it's art, entertainment, and recreation in blue. And that's why we're very concerned about corporate debt. The third risk I want to highlight comes from emerging markets. As you can imagine, the challenge of this pandemic is bigger for lots of them. The health and economic shock is huge. It's compounded by low commodity prices for many of them. They have a large share of informal workers, difficult to reach for social protection, and the path to recovery is highly uncertain. And they have financial issues. The money outflow, which is represented by the red line, is greater and more abrupt than in any previous crisis episode. It far outstrips the global financial crisis outflows in blue, or any other, like the temper tantrum in 2013 or China market sell-off in 2015. So why are we concerned about this? We fear that weaker local currencies, less foreign reserves, and the global recession will make it very hard for some of these countries to keep up their external debt payments. Now, the situation is tough. The risks are serious, and comes the time of difficult policy recommendation. And the first one I'd like to make is really let trade help fight the virus, not protectionism. To avoid a second wave, we should test, track, trace, and isolate and build enough protective equipment stocks like masks. Trade barriers on health equipment will not help. Reshoring might take a while and it might make it a lot more costly. The left-hand side chart shows there's no denying that healthcare equipment production is very concentrated in a handful of countries. Therefore, it's normal that firms and countries to improve the resilience of sourcing, wish to improve, the resilience of sourcing through diversification. But trade restrictions, like the one we've seen in this crisis, like what you can see on the right-hand side, with a rising number of export controls on medical goods, they are not helping. They can block a country's own production if they stop components going to their own suppliers, and that will hurt everybody. More generally, we've seen this trend towards trade barriers before, and we have warned about it. I think the lessons from this crisis is to diversify supply, to build up stocks, production capacity, move from just in time to just in case. But as we go through this crisis and get the economy going, we should think that trade is part of the solution. Then I would like to focus on people. In the containment phase of the crisis, governments have provided massive and rapid support to workers on scale we've never seen before. You can see the blue bar. It's the number of people in firms who applied for job retention scheme. And even the green bar that you can see on the chart, they should not be misleading. Some of these workers also retain a link to their employers. But what this chart really shows, it's the possible scale of the unemployment problem. Now, the challenge that we have is that a number of sectors may face persistent lower demand, and that's travel, hotel and restaurants, leisure, entertainment services. But there will also be sectors with greater prospects. E-commerce, courier express, parcel services, healthcare, equipment, to name but a few. So what policymakers should do? They should actually ease the transition and protect workers' income. That means, for example, financial incentives for firms to rehire former employees, expanding training and public employment services and schemes, especially for young people entering the labor market. We need job placement services much closer to people. Ensuring the adequate generosity and duration of unemployment benefits. And above all, making sure vulnerable people receive both an appropriate income and support to find a job. The next is firms. In the first phase of the crisis, government support for companies, like for workers, has been huge through wage subsidies, tax deferrals, guarantees. And what you can see on this chart is absolutely enormous. They go from 5 to 10, 20, and even 35% of GDP. Okay, these are allowances. It doesn't mean governments will spend all of them. And they will need to evolve because we're in transition phase. There are several possible options. First, we could convert such deferrals into public equity stakes with a transparent and fair framework. Government could ease insolvency procedures to ensure faster restructuring without stigmas for entrepreneurs. They could transform loans in grants or tax credit for smaller firms to give them time to rebuild. Now, obviously, all this will continue to put pressure on public finances, but continued fiscal and monetary support is not only necessary, but it's also very feasible under current conditions. So look at this, because I don't want to minimize the public debt issue. But what I want to make clear is that we cannot repeat the mistakes of the previous crisis and consolidate too quickly. As long as the economic situation is dire and unemployment high, there will be no pressure on inflation, as you can see from our projections on the left-hand side. And central banks will have to keep rates low to help economies recover and to reach their inflation target. And what that means is that debt service payments, which are represented on the right-hand side chart, and which are already very low for many countries, will not increase quickly. So as long as growth and employment remain subdued, governments should keep going. They should only adjust when the recovery and employment growth are firmly on track. Now let me conclude and wrap up a few messages. The COVID-19 pandemic has already damaged the economy, firms, and people's well-being. And we need to make sure that this harm does not become long-lasting. Governments have played an impressive role, and they can still play a very impressive one. First, and above all, put resources into health. Test, track, trace, isolate, in addition to physical distancing, is the only way to control outbreaks as much as possible, and even reduced, so that life with freedom of movement can recover faster. Second, they should help the unemployed get into quality jobs. It's an absolute priority to prevent a huge wave of people losing their job or that have lost their job, disproportionately the low-paid and low-qualified and the young people, falling into long-term unemployment that will scar them for life. Third, Governments need to help firms and entrepreneurs restructure quickly and get back into business unencumbered by the burden of huge debt. Fourth and last, the policies for the recovery government designed today will shape our economies for years to come. Many economies need improved welfare systems, smarter regulation, better healthcare and education systems, more effective government, and better trade. To end and to adapt an expression by Eleanor Roosevelt, who said, "I am who I am today because of the choices I made yesterday," the world will be tomorrow the world will be in tomorrow is designed by the action that we are taking today. Thank you.
Thank you. We'll now take some questions from the journalists. The Zoom application has the question and answer facility at the bottom, so we're open to further questions. We have a first question for the Secretary General from Tim Young of the China Economic Daily, who asks, what is your expectation for cooperation between the OECD member countries and China to get through this global pandemic and to boost recovery of global growth?
I would quote what Laurent said a moment ago. Trade, more trade, even more trade to reduce the trade tensions, particularly between China and the United States, because they already had cost, even before COVID, had cost the world 1 to 1.5% growth. And because they are, you're talking about China, second largest economy in the world, one of the largest trading partners. Obviously, they have to be part of the solution. So I would say that any solution and this strengthening of international cooperation has, of course, to include China as a very active player.
We've got a sort of follow-up question on that, is how do, perhaps for Laurence, how do you review China's efforts so far to recover its economy and to rebuild the global supply chains?
So I think it's too early to tell for many economies how they will recover. As you know, and as we mentioned, the uncertainty is massive, and there are many challenges. And one of them is in the previous global financial crisis, then, China was still striving to be the world leader exporter. Today, it's very different. China is trying to rely on its own consumption, and the rest of the world actually cannot lift China's economy through their imports. So I think it's going to be much more of a struggle. Let me give you an example. In the previous crisis, China's export accounted for a large bulk of Germany's recovery. Today, the exports that Germany could direct to China have been halved. So that gives an example of the magnitude of the change we've seen.
Matthew Cranston from the Australian Financial Review asks Laurence, why is Australia doing so much better than the rest of the world? And a follow-up question is, do you expect these forecasts to actually recalibrate the credit ratings?
So there's a handful of countries who, for a variety of reasons, have been hit less hard by the virus and have managed it more quickly. I would say New Zealand is one of them as well. So the confinement period could be less long and in some cases less strict. And then, like many other governments, the Australian government has been very efficient in shielding firms and workers. So now that the sectors are reopening with the end of the confinement, we're seeing this very V-like upturn. But again, I would warn that this is because we're reopening sectors, but there will be large sectors, large parts of activities remaining impaired. I just give you an example. As you know, tourism from Chinese students accounted for a very large part of Australia's GDP, and that's obviously over for a very long time.
And also, just remember that Australia had 3 decades of uninterrupted growth. So, in that sense, the momentum, the inertia that they had was quite positive. And on the other hand, that Australia is a relatively large, open economy, and it depends a lot on trade flows. If the trade flows stop or are reduced considerably, then of course that will have an impact.
A number of journalists are asking about the labour market impacts of the crisis. What can governments do to help the unemployed get back to work?
Well, they are already doing that in rather massive ways. I mean, it's not in the billions or even in the hundreds of billions. Now we're talking about trillions. You know, it's a new unit when you're talking about rescue packages and supports. Now, not all of that is expenditure. As was mentioned by Laurence, a lot of those sources of support have to do with guarantees, with loans, with liquidity. And that includes also the support of the central banks. So basically, you're talking about how to keep the companies going, but there's a lot of support for people, for individuals, for the persons who may have lost their employment, to keep them not only with a revenue, but also linked to their companies. This is one of the most important elements of these packages of support, that they don't lose contact with their companies. And therefore, when the moment comes to quote unquote, normalize or stabilize things, then they maintain the relationship with the country, with the company, and they can restart a lot easier.
Just to complete, perhaps, as the Secretary General was saying, there has been very large and, in fact, blanket support to workers and to people in the first phase of the crisis. Now, with the reopening of some sectors, but the virus being still prevalent, what's happening is some sector will work very well. And we've seen that with e-commerce, of where courier services or other digital related type of job, but also care, healthcare, and some work, some qualification into the healthcare system. But in other sectors, like you take, airline industry and all the equipment that are provided to them or supplied to them, you take restaurants, hotels, then they're either not functioning, airlines, or very little, or they have to function in a very, very different way. And they might obviously not make as much business as possible as before. So we are in this period where you want people who were retained in sectors that are going to be impaired for a long time to actually move to other sectors, which will be striving in the forthcoming recovery. And it's an enormous challenge for governments, because they cannot obviously tell by themselves which sector is going to grow and which is not. So what that requires is amazing flexibility and agility from economic policy, ensuring that people are covered with some kind of income, but that they also get the training they need to actually move sectors when they need to. This situation is going to last for a year or 18 months. We need everybody to move forward and get some hope that they can do things elsewhere. And this transitory phase with maximum flexibility from labor market policy, adjusting parameters, is going to be challenging, but it can be done.
A question from the Baltic News Service. Where should governments invest borrowed money in order to reap the benefits for the long term? Should the money be spent on reducing social inequality, on education, on digitalization?
One of the problems that countries face today is that the answer to that is all of the above. The other question is that in the Baltic countries, for example, which are already highly wired, highly connected. Maybe they don't have to invest so much on connectivity or on digital, whereas some other countries that are much less connected, they will have to spend more. They will have to update and upgrade their networks. And also, in many cases, they will have to update and upgrade the preparation of their teachers, as we have seen, for example, in the billion-plus children that today are out of school, and in many cases, no connectivity, no tablets, but also no teachers that have the skills to be able to deal with them at home.
If I may just add a couple of comments. I think one thing which is very clear, and again, data high, but we should not repeat the mistake of yesterday and adjust too quickly. The second is the type of investment that's being done today, as we were both saying before, is designing the world of tomorrow. In the past crisis, government sometimes supported activity like in the automotive industry without distinction about whether it was the money was going into clean investment, into green cars, or whether it was, fueling the cars of yesterday, which are polluting. Today, we're seeing a change. If you look at the support given to the automotive industry in Germany or in France, it's actually going into the direction of better, cleaner car. And I think that's a sign of what can be done to actually shape a better life for tomorrow.
We've got a number of questions, particularly from the Spanish press, from El Mundo, from EFE, asking for comments on the differences of the impact on the hardest hit countries in Europe. Why have countries like Spain, the UK, France, and Italy been so hard hit?
If I may?
Please.
I mean, in my view, this is not the point, right? We're all being very hard hit by the virus. It struck at different points in times with different preparedness, depending on whether you've seen before how countries adjusted and so on. But it's not the point because we're all in an integrated world. And it will have some differential impact on economics depending on economic specialization. We know that tourism is being very hard hit. Services which require physical or close to physical contact are being very hit. And some countries have a higher proportion of their value added in those sectors. But the fact of the matter is we're all in there together. It's been dramatic, and it's only if all of us can get out of it together that we will feel better. In that respect, I think it's really worth highlighting the major progress made by the Europeans with the European Recovery Plan, because that is precisely designed to address the divergences that we are seeing in economics as a consequence of the COVID crisis.
There's also the very obvious and simple question. These countries all, depending on the different stages in which they were facing the problem, all went into very tight confinement decisions. And that, of course, lowered the incidence and lowered the mortality and made it possible for their health systems to deal with the pandemic. And so there, I would say, you have that a case where virtue has its own reward, except when you look at the numbers in terms of growth, they reflect the fact that they were closed tighter and for longer, but now they're reaping the rewards.
There's a question from Will Horrobin of Bloomberg, who's asking for a comment on the different ways that Europe and US has responded to the unemployment crisis. He's asking, is there a risk that in Europe the real unemployment will be slow to come and it would leave us with structural unemployment a lot higher after the crisis? Which is the best model to deal with this unemployment crisis, the US one or the European one?
Again, if you allow me the technical answer,
Please.
again, I don't think this is the way we should look at it. Actually, the first phase you really needed to protect everybody, and that's what both types of government of action have been done on both sides of the Atlantic. Now we're in this difficult transition phase where some sectors are opening, others are not. You would have thought that if we have two rigid short-time working schemes just keeping people in firms, then it would be more difficult for them to transition. But I think what we've been very impressed with and continue to be impressed with at the OECD is the agility of governments in moving forward and starting adjusting parameters already, so and looking at the regulation to make sure that the transition and the turnover between jobs and sector can materialize quickly. So I think, you have that on the one hand, and on the other, providing income to everybody is also providing a buffer to the drop in consumption that's also helping to keep activity higher. So too early to tell, lots of agility is needed. And I think we'll see that governments have been very forceful and will help throughout.
And also the fact that, when you look at the United States, 50 states, each one of them now running on their own in terms of their own decisions, their own reopening, the speed, what sectors, etc. Also very diverse in terms of what kind of companies do they house, and therefore the impact. If they're more service related, that means you can go into confinement and you can work with your computer at home. If they're more of a manufacturing types of jobs, you have to be there. Those states which were more service oriented, where people actually have to be working on the hotel or working on the table or working on the airline, etc., hardest hit, of course. But in the case of Europe, what you have is, just the European Union, for which decisions are made on trade. Well, you're talking about 28, and then you're talking about the rest of the countries that depend so much on what the 28 do, and countries that are so fundamentally dependent on the automobile industry. When you're talking about Slovakia, for example, just use one case. Well, basically, you're talking about if the German or the French or the UK industry of the automobile is now coming to a standstill, basically, there's going to be an impact in those countries that supply the auto parts, and which thrived precisely because of the growth of the automobile industry in the past. So again, the question of reconversion comes to mind. The question of diversification comes to mind.
A question on Italian debt from Roberto Vozzi of ASCA. You expect Italian debt to GDP at 170% in 2020 in the event of a second wave of infections. Is this sustainable? Do you think that Italy should use the new ESM line for COVID pandemic related expenses?
Yes, they should, because they need it. The conditions are absolutely, appropriate in the sense of so it's available. My own country, Mexico, just took $1 billion from the World Bank, for example, yesterday. Well, why? Because these are facilities that were created for the purpose of strengthening the health systems and the domestic systems. This is what they are for. So, and this is part of the European solidarity. These are why these facilities were created and why these facilities are being put in place. Okay. Now, the question of the debt, it will get to a certain level depending on where you start. There will be, in practically every case, an increase in debt. But that absolute level will not be exclusively because of the COVID response. It will depend on the fact that you already had a certain level of it. However, please, and let me just insist in what Laurent said a moment ago. this is not the time to be applying the rule book, not the time to be looking at those 3% limits of the EU and all that. Right now, you put everything you got in order to fight the virus, to win the war against this enemy. And then you will have, of course, to deal with the fact that countries and companies and households will have a larger, higher amount of debt.
Perhaps I can bring a couple of precision. The first thing is I think one should be careful not to confuse the national account definition of debt and the Maastricht definition of debt, because that would give a misleading impression. The second thing I would like to say is the pandemic has affected countries in such a way that all of them are seeing a jump in their debt to GDP ratio of the order of 20 percentage points. And Italy is no different like that, but in this way. The third thing is there is the European Recovery Plan, which is precisely designed, as we were saying, to address the divergence in economic activity due to the pandemic. This European Recovery Plan, as you know, is mostly announced as grants. And the advantage of this plan is that the grants do not add to national debt, because given where interest rates are, every single country can borrow very cheaply on the market. That's not the issue. But the fact that you get those grants, that they are designed to tackle the divergence between countries without adding the debt, is, I think, the best thing that has happened, one of the best things that has happened in this crisis. And when this announcement was made, and later followed by the European Commission endorsing it and proposing it to the entire Europeans, all the spreads on debt went down. I think that's a very strong expression of how European solidarity is actually helping addressing the crisis and giving governments the tools to address the crisis.
We've got time for one more question, and I'll take Philip Inman from The Guardian in the UK, who asks about the outflow of capital from emerging markets. What should countries do to mitigate the negative effects?
This is not a new phenomenon. Every time there is uncertainty, there is capital flight. And here there's always, normally to the dollar. In this case is no exception. So you've seen a period of very strong dollar because of these flows, etc. So now what is happening is that you're seeing in the case of large developing countries, which have a larger capacity both to attract but also to put out resources. A very, what I would call a mosaic of reactions. And it has depended on the domestic policies. It has depended a lot on whether the perception of investors, in both foreign and domestic, was that the government was doing the right thing or not. So it's not in general, but yes, there is normally flight to, quote, quality. This is the way the phenomenon is called, whenever there is uncertainty. And right now, uncertainty is as high as it has ever been.
Well, thank you very much for listening in. We'll leave the press conference there, but just let me remind you all that all the material is on the OECD website, together with a lot of information about the OECD's policy recommendations in response to the pandemic. Thank you very much.
Thank you.
Thank you.